Oh, we're live. Okay. Hi, Jett. Welcome to Venture with Grace.
Hey, Grace. I'm thrilled to be here. Thanks for having me.
Amazing. Okay, to start off the show, I would love for the audience to learn more about you. And I feel like, again, like I mentioned, like I feel like Hotline has been like really building, like it's a brand that's like really up and rising. And I feel like I constantly see it on my LinkedIn feed. And let's start with like your past experience. You have worked at Cambridge Associate, Fung Capital, and then Palantir prior to starting Headline. Can you give us a quick TLDR on like what are the core lessons from each places that kind of help you build Headline?
Yeah, I'd be happy to, and I'm really happy to hear too that you're seeing us more and more. I mean, the reality is, Headline's actually been around for 25 years now, and so building a brand in venture capital takes patience and it takes a long time. And so I'm glad to see that all the work that we've been doing over the past couple decades has been paying off. Um, I joined Headline a little under 11 years ago, and at the time we were a very small fund, about $90 million in AUM, focusing on the U.S. and Europe. And at the time, very few early stage venture capitalists focused on Europe. Europe was a place that private equity went, growth equity went, but there weren't a lot of VCs, professional VCs in Europe, and definitely not VCs that were focused on the US and Europe. And so I was pretty excited to join a firm that did focus on both of those geographies. And we can talk more about that, but needless to say, over the past decade and some, we've built out our presence in Europe significantly, and now have teams on the ground in Paris, Berlin, London, um, and are very active in that region. After myself, after college, I went to Stanford, and after college, I joined Cambridge Associates, which is a consulting firm, for those that aren't familiar, that actually focuses on the LP community. So they help pensions, endowments, families, foundations, hospitals, these large institutional investors invest their capital. And so I joined Cambridge Associates and was lucky enough to be working on a number of venture capital mandates, helping large limited partners find venture capital funds to put their money into. And
Mhm.
after meeting with enough VCs through that process, I was really excited about the prospect of being on the other side of the table, being on the venture manager side. And so I ended up leaving Cambridge and joining a small venture capital fund in San Francisco, where I was for a short period of time. And then, with a couple of detours after that, including one to law school, I ended up at what's now Headline a little under 11 years ago.
Amazing. Okay, so I want to start with like, when in your journey of working at Cambridge Associate, like what are some core lessons that you have learned that like, VC firms are doing right versus, you know, like what are things that you feel like people should not do at a VC firm?
Yeah, absolutely. Yeah, I mean, one of the things that you learn pretty quickly is sort of the benefit of persistence and having a very long-term mentality and discipline. And so when we were looking, the LPs, rightfully so, they want to invest in stable venture capital managers, right? They want to invest in venture managers that do what they say they're going to do, that have a very long time horizon, where there's not a lot of volatility in terms of team turnover, right? They're stable.
Mhm.
And so you learn, about that persistence and that discipline and how important that is. And it ends up actually impacting returns, is what we saw. And so I think that that was one of the big learnings for me after seeing hundreds of VC pitches and helping these large institutional investors place their capital, was that, the VC managers that were stable and that did what they said they were going to do ended up outperforming the ones that may have, gotten short-term greedy, gone off strategy, veered out into a sector that they hadn't, set out to invest in. Um, um, and of course, then the managers that were super volatile, right, where people were coming in and out constantly, and that's always a challenge. So that's what I learned at Cambridge Associates, and they really taught me how to be an investor as well, and it was really my first exposure to this asset class of venture capital, and to really view it as an asset class, right, is what was a real gift, because at the end of the day, we are working for the LPs, and it's our job to deliver returns to our investors. And so being able to see that from the Cambridge Associates side of the table was a very special opportunity. I think, a lot of people come into this business, super excited, of course, and we all are, about the startups and about these novel ideas and sort of the beginnings of these companies, but we are a part of an asset allocation for large institutional limited partners, and I think that's a very important part of the business that doesn't really get taught to younger people that are coming into this business.
Totally. I feel like so to dive in a little bit more about like I guess like headlines. So what are some thinking that's like behind I guess like how did you guys grew from like $90 million to like $4 billion under management? Can you give us like the general strategy that I guess like you guys have done differently versus like the previous years?
Yeah,
And yeah,
yeah, yeah. It's a great question, and it's been fun, right? I think that's key too, is that it's been fun, and um, we're very lucky. I'll say that first, right? I think there's always an element of luck, and luck is created in a way which we can talk about, but we've been very lucky to have consistently produced top decile returns for our limited partners in our venture funds. We've done it in a sort of quiet way, I'll say, and then that may be changing a little bit with our brand, but I think we have done it our way, which has been a little more quiet. But fundamentally, the reason we were able to grow so significantly was because we produced real returns for our investors, right? And that's what the LPs obviously want and need, and that's our job. And so, like I mentioned, every one of our funds for the past few generations has been a top decile fund. We have been very stable as well, right? It's been a very tight knit partnership for the last decade plus, and we execute the strategy that has remained consistent for over a decade now, and we can talk about that. The other thing we've done, which I'd love to get into, is we've built processes and tools into our business that allow us to create repeatability um, in our sourcing efforts and in our picking efforts. And I think that that's been a real benefit to our performance, and that's in fact catalyzed some of our performance. And I think the LPs recognize that repeatability is rare. It's hard to find, particularly in the venture capital asset class. And so when we talk about stability, right, and predictability of returns, I think some of the things we've done with building out our processes and our technology have created that repeatability that is really hard to find in this asset class.
totally. Can you elaborate a little bit more about like the technology that you guys would leverage to kind of build the process of picking, sourcing related things?
Sure. Yeah. So, so one of the things that I think distinguishes us from many other venture managers is that for over a decade now, we have had an in-house technology team of engineers that has built products for our investment team, proprietary tools that our investment team leverages to both source and analyze fast-growing technology startups. And this was really started about 10 years ago with the realization that, in order to generate real alpha in this asset class, that we had to do something different to find companies that were a little different before other VCs found them. And so we hired a few engineers to start building tools that surface companies that are going very quickly. And we take in all of this data from across the internet, probably 30 different signals. And we analyze those signals and we make them digestible to our investment team so that fast-growing companies are surfaced to our team in order for our team to reach out. And that was the first thing we did. And when, 10 years ago, it was very primitive. It's come a very long way. We now have about 20 full-time engineers that work at Headline building this tool and one other, which I'll get to in a moment. And several of our very successful investments were discovered using this technology. And so it's become an important piece of our sourcing process. Now, that said, it's one leg of the stool. We still do all of the other things that many of the other VCs you've spoken with do. We go to coffee, we go to cocktails, we network, we meet other VCs, we meet founders, in their offices. But the technology piece has been an important way for us to find companies off the beaten path before other VCs find them. And let me give you one example. We invested in a company called Bitwarden about 5 years ago. Bitwarden is an open source password manager. So if you use any password manager like LastPass or 1Password, Bitwarden is in the same category. It's open source. And our technology surfaced this company and noticed that it was growing extremely quickly. The company is based in Jacksonville, Florida. And when one of our analysts called the founder, Kyle, in Jacksonville, he had never spoken to another VC ever. We were the first VC he had ever spoken to. He had just signed up as a customer, NASA, when we called him. Mm-hmm. And so our ears perked up. And we ended up leading the first institutional funding round in that company. It's been an exceptional grower. It's been growing extremely quickly and very capital efficiently. They've raised a lot of capital since our initial investment, and we would have never seen this company, except for the technology had surfaced it. And so, that's a good example of how our technology takes us to different corners of the country and to founders that may not have spoken to other VCs before. And so it plays a role in our holistic sourcing efforts in addition to sort of our network-based sourcing. So that's the first piece of technology that we've built. The second piece of technology is an analytics tool that helps us analyze companies, get under the hood to understand whether there's real product market fit. And that's a product called Deep Dive, and you can go to deepdive.headline.com. It's open publicly. You can put in company data, and you can analyze your own companies yourself. And for the VCs that may be listening, you can use this tool for your own due diligence efforts.
Amazing. Okay, so I want to hi David, I want to quickly say hi to the audience. So I have a question about like, so for the sourcing tool you mentioned, like I guess like without giving too much detail as like as much as you're comfortable with, obviously, what are some core things that you'll be looking for in this tech? Because I've heard multiple times about people would source from like, I don't know, a SpaceX engineer just left and like become stealth mode and then like
Yeah.
maybe tools to like analyze these like people related things or oh blah 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 company incorporate somewhere like those are like the things that people are looking for. But like I wonder, since like you mentioned about this company in Jacksonville, Florida, like that they signed with NASA, obviously that's like really big indicator before the news broke out or something. Um, how like what are some benchmarks you guys used to leveraging the technology to fund these companies? Like what would be like
So
the
it's
keywords?
a yeah, totally understand the question. It's very tied to our strategy, right? So our
Mhm.
strategy is product market fit and beyond. So we don't invest in companies that are pre-product market fit, right? And so the SpaceX engineer that just left is in stealth mode in the garage, tinkering. That's amazing, but it's not our strategy, right? And so we'd love to sort of track that company, but until they have product market fit, it's not going to be of interest to us. And the reality is 99.9% of companies never achieve product market fit. Even the most talented engineers coming out of the best companies, right? The exact, you know, even they're not guaranteed product market fit, right? And so we start at product market fit. And so
Mhm.
for us, what that means is, the number one filter is growth, right? Company's not growing, probably doesn't have product market fit, probably not interesting to us, right? And so we're looking for signals of growth. And the most basic, signal of growth is web traffic, right? Are people actually coming to your product or service or website online, and are they coming more and more over time, right? And so we're looking for that signal of growth. And then there's, like I said, we have about 30 different signals we look at, including, sort of ones that are more well known. So headcount growth, right? But there's a lot of others that we use. We've built some proprietary composites as well that take in a number of different factors to predict growth. And so we look at all of these things, but growth is the foundational sort of trigger for us, if you will, right? If it's not growing, it's probably not going to be interesting to us. And so that's the number one thing. Once we see something that's growing, we then reach out to the company, we talk to the company, we validate the growth with the founder. And if it's in fact growing, then we want to learn more about the unit economics. We want to learn more about the capital efficiency. We want to look under the hood of the company, right? And we want to look to see if in fact that company is a fuel efficient car or not, right? And that's sort of where the second piece of technology comes into play.
I wonder, so I have like two quick like piggyback question for this. One is like I have seen like other VCs or like just people in general have been analyzing, call it like app store data, like how many people commenting on like app or like how many people review like a certain things, or it's similar to like maybe the SaaS model, which is like how many GitHub star you're getting. So
Mhm.
what's I guess like beyond these kind of like benchmark that's more obvious, is there, let's call it like around your 30 different benchmarks, is there something that like you feel like maybe maybe you can maybe talk about one things that like maybe not the entire 30 benchmark, but like maybe one thing that maybe it's surprising for like most people, but like you feel like it's important.
Well, I probably shouldn't get into the
Mhm.
specific sort of
Okay.
data
Yeah.
sources and metrics,
Or
but I'll say,
maybe not talk about the metrics, but like the general direction that you feel like are important for the founders that are like people are like, wow, that's interesting.
yeah, I mean, actually, when we reach out to founders, we share with them a screenshot of our data analytics. So they see what we're seeing, a portion of it, right? And
Mhm.
and I think for them, it's often pretty interesting, particularly if we found them before other VCs have found them, right? Again, most of these metrics that we use indicate some level of growth.
Mhm.
And I won't get into the specifics about what all of those are. Web traffic is foundational. It's the first one we started with a decade ago. It's still important. We've gotten more sophisticated with it, but that's sort of the foundation of everything we do.
Totally. I wonder, so let's talk about like the different subsector that you guys are looking at. So I think one thing
Sure.
I thought was really interesting was, like you wrote this article or co-write this article with one of your colleagues. It's about passion economy, experience, self-improvement, convenience, combating loneliness. When I was working in venture in China, I feel like the combating loneliness is definitely essential. People are lonelier than ever. I feel bad to hear that, but like
Yeah.
it's kind of true. But I wonder what are some interesting companies that you're seeing in these spaces? And
Yeah.
yeah.
Totally. Yeah. I mean, I'll start, I completely agree. I mean, it's undeniable, this loneliness epidemic, right? It's affecting both young people, old people, kind of, it's sort of equal almost, right? And there are a number of different sort of sub themes, I think, that sort of fracture off of that macro
Mhm.
theme,
Mhm.
right? So I think, the pet space is a sector that, addresses the loneliness epidemic in a
Mhm.
pretty meaningful way and has for some time. And we invested in a company about 8 years ago called NomNom, which was a direct to consumer dog food
Mhm.
business that we ended up selling to Mars. And, indirectly, that is a play on the loneliness epidemic, right? I think
Mhm.
people are going to pets, now
More than
virtual
ever.
companions, right, and AI companions, right, to help solve this problem. But pets certainly um, has been a big way that folks have addressed this. Obviously, the entire mental health sector, right, is
Mhm.
sort of a sub theme off of the loneliness epidemic, and spent a lot of time and energy thinking about the mental health market. Then I think one of the areas that um, we're very excited about our online communities, right? Online communities have the ability to help solve loneliness for different demographics. And so, we've invested in a few online communities, one of which is unannounced. And we're excited about the ability of these companies to help people find companionship, friendship, um, social lives, a connection, right, online. And so, um, that's a sub theme. And then I would say the last sub theme I'll just briefly mention is sort of, it's related to online communities. It's niche passion communities. So whether it's anime, collectibles, fashion, etc. These are all places that people go when they're lonely to find meaning and find
Mhm.
connection. And so those are places that we tend to look as well. As far as ways that we think the loneliness epidemic can be solved.
Totally. How do you evaluate, for example, a Num Num versus like their competitors? Because I feel like there's just so many pet food businesses out there. Like, I know that you talk about like the selecting criteria, like after they meet like product market fit. How like after the certain 30 benchmark that you guys are using for that, like, and you send the screenshot to the founder, like, what are some like what would be like the question that you would ask a founder to evaluate if they are better than like their peers?
So I'll first say with NomNom specifically, I mean, we made that investment at a time when the direct-to-consumer fresh dog food market was really in its nascency. I mean,
Mhm.
there were three companies at the time. They'd all started at exactly the same time. It was not clear at all who would be a winner, who would not be a winner, right? And so we we knew about the other competitors. They were all exactly at the same spot, right? And so what we looked at was the team. We looked heavily at the data, early data.
Mhm.
You know, the company was only doing about $40,000 a month in recurring revenue.
Mhm.
But this is an important point. The revenue was recurring, right? And
Mhm.
so we could look at the retention, the revenue retention, right, which
Mhm.
is extremely predictive of success in any business. And the revenue retention had a very clear asymptote or flat line, meaning that there was a segment of the consumers of the revenue that stuck around forever, right? That ultimately is what builds real enterprise value for any business. And
Mhm.
so we knew that there was something there, right? And then it was a question of execution, and that was part of the team analysis, right? And felt like that team could execute very well, and they did, in fact. And they are the only company that has had a major exit in the category. And so it was really the data plus the team when it was that early. You know,
I
and actually, oh, go ahead. Yeah.
no, you first.
I'll say that this is fundamentally the same way we evaluate companies today. I mean, we 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 tend not to like to go into really mature sectors with tons of mature competitors,
Mhm.
right? Um, that we like less than going into a
Mhm.
nascent sector with emerging competitors where there's yet to be a winner, right?
Totally. Um, I guess, like, couple questions there. One is, like, since I feel like, number one is, like, when you mentioned about, like, the 30 different benchmark that you would use to evaluate a business, um, what how do you kind of A/B test if some benchmark just works better than others? And since, like, venture is, like, a really long has a long life cycle, um, like, it's hard longer feedback loop, like, how do you kind of evaluate if some of the benchmark should be maybe retired or like some new ones should come up to like add to it, and also not too sophisticated as like maybe it's just filter out too many good businesses or like businesses in general. um yeah.
Right. Well, I guess I'd love to talk a little more about what you mean by benchmarks, because fundamentally what we're doing is you know, in most businesses, there are some business models where this doesn't apply perfectly, but I'll say for most businesses, the core thing we're looking for is whether a segment of customers gets long-term value from the product or service, right? That is what creates enterprise value. It applies to technology businesses, it applies to analog businesses, right? If you think about, you know, a silly example that I always like to use is think about your favorite coffee retailer, Starbucks. You know, how long have you been going to Starbucks for, right? Forever, right? And
Mhm.
probably go once a week, if not more, right? And you go forever. And so that ultimately creates same with technology businesses, right? Customers and revenue that flatlines, that doesn't churn, creates enterprise value. And so we look for a flat line in revenue retention or activity retention, right? And so this is also an important point. Some companies don't have revenue, but they have usage, they have activity. They have users that are going to the product and using the product. May not be paying them, but they have usage, right? And that is highly predictive of success. If a user goes back over and over and over again to a product and doesn't churn and continues their usage or increases their usage over time, that's very predictive of the creation of enterprise value in the long term. And so we're very open to looking at usage or activity retention. In fact, sometimes even more than revenue retention as a predictor of enterprise value creation. So that actually throughout the cycles doesn't change, right? That stays the same. It's been true of businesses, forever, right? As the key thing that ultimately creates value. And so that's what we're looking for. And so, multiples in the public markets can come and go, they'll change, they'll go up and down. But this core insight of, does activity, engagement, or revenue stick around forever? That's key. And that stays the same. And so that's really the insight that we are looking for almost in any business.
Totally. I wonder, so as for like, um, from like evaluating the retention, I think some business may have a upstart from the very beginning, but like when their competitors start catching up, let's call it like you mentioned, like you don't want to invest in like companies that have like matured competition. But what if it's like a matured company go after this market? Like for example, let's call it like if a company that's making uh like, I would just use, like, maybe ColourPop as an example. I mean, I don't really know the numbers, like, which is, like, a makeup company, and then later on, they were, like, um, I'm just gonna use I don't know what's a good example. So, basically, let's say, like, if you're a makeup company and then Kylie Jenner decided to start a makeup company that's, like, very similar to whatever you're doing, maybe you're also your supplier is their supplier, and then your
Mm-hmm.
business would be, like, killed by that business.
Yep.
So how do you kind of, like, quickly evaluate if a
Sure.
market would be easily to
Sure.
get, like, a competitor that's really big?
Sure. I understand the question. So I think two things come to mind. So first is, one, is there a truly novel and differentiated product? Is the product really 10 times better than the incumbent?
Mhm.
And two, is there a distribution advantage? So your example about Kylie Jenner is interesting because there's a real distribution advantage with her celebrity, right? That
Mhm.
is unique, right? That maybe the incumbent doesn't have, right? And she can leapfrog the incumbent because there's a real distribution um, benefit to having her as part of the company. And then the first point is maybe there's not a distribution advantage, but maybe the product is really 10 times better. Maybe it's in your example, maybe the ingredients are that much better. Maybe they're non-toxic. Maybe they're made from plants. Maybe they're easier to apply, right? Who knows? But is the product really uh, leaps and bounds better than that incumbent product? And so we're evaluating both things, right? And obviously, if you have both, if you have a better product and a distribution advantage, um, we would invest in a company even in a mature market where there are mature, you know, incumbents and competitors.
Totally. How so like I know that you invested in a company called honeycomb.io. I
Right.
feel like in that space there is like I know they're like the leaders of the space and a lot of like startups are coming after this market. I guess like using that as example, like what are some different benchmark that you would use to evaluate a SaaS software versus like a consumer related companies?
Sure. Yeah. I mean, I'll start. Honeycomb. I found Honeycomb, probably 8 or 9 years ago when they were just getting started, right? And this was truly a case of a better product, like what we were just talking about.
Mhm.
The observability market. In fact, Honeycomb defined. I mean, they created the word and the market of observability. This was not a term that Datadog was using. This was not a term that Splunk was using. Honeycomb created observability, and all of these other mature competitors started using that term. And so they really did create that market and that marketing, and their product is leaps and bounds better than some of these other competitors, mature competitors that I mentioned. We can get into that if you'd like, but it truly was a case of better product there,
Mhm.
and not to mention the Rockstar team and just a number of really defensible, exciting moats in that business. Um, I think you asked about sort of the metrics for software versus consumer. Um, again, without maybe getting too deep into the weeds, I would say that actually across a lot of these sectors, we're looking for we're trying to validate this insight that I had mentioned previously of, does a segment of the customer base stick around forever? Whether it's, do they continue to use the product forever or do they give me money forever, right? And so in software, typically what that means is, we like to see net dollar retention greater than 100%, right? Means that over time, they're expanding their usage, they're paying more money over time. In consumer, particularly consumer subscription, consumer business models that have some recurringness to them, right? We like to see a flat line in activity retention, usage retention, or revenue retention, right? And so we're looking for that signal that folks, customers, users stick around into the long term indefinitely. There will always be some segment that churns and goes to zero, but you've got to have a portion, and it doesn't particularly matter where if it's 5% or 50%, but there's got to be a portion of the user base that sticks around indefinitely. That's how you create enterprise value.
Totally. Since I feel like in consumer, like, so I guess like when it comes to, like, you mentioned about like stick around indefinitely, or like what are the companies, like how do you feel like the company should keep evolving? Because I feel like if the product doesn't change at all, it's like harder to maintain the relevancy to the customer, because I feel like most
Totally.
product and businesses have to like evolve throughout time. And like, how do you kind of like evaluate their ability to adopt newer technology, or capturing the stability market share you were mentioning?
So companies have to innovate, right? Or else they're sitting ducks. And it's like I mentioned, right? Then a honeycomb comes along with a 10 times better product. And consumer companies, all the same, right? I mean, consumer companies probably even more so, right? I mean, consumers are very smart investors with their time and their money, right? And they move more quickly than businesses. And they will, if you don't innovate, consumers will move on to the next hot thing, right? And so if you look at some of the consumer winners of the past decade, if you look at Pinterest, if you look at Meta, if you look at Snap, right? These are all companies that they got to some level of incumbency, and we could probably have another podcast to debate whether those companies are innovating or not, right? And they do it in different ways. Meta has done it through inorganic methods. I mean, they've acquired a bunch of companies, right? WhatsApp. Early on they acquired Instagram, right? Started new products like Threads, right? So they've done a mix of things, right? And but fundamentally, yeah, these companies have to innovate. They have to keep on building new products. Oftentimes, when you get to a level of maturity, you start to acquire companies, and so you grow through these inorganic ways. And that's also another way to keep things fresh. I mean, look at on the B2B side, look at Salesforce, probably one of the best sort of acquirers of all time. Right? I mean, they've done that's how they keep things novel.
I wonder. So I want to like dive into the consumer side a little bit. Like, you invest in Fancy, which is acquired by Gopuff, and Gopuff is like a company that I feel like really interesting, because I just started hearing about it, maybe call it like 2 years ago, but they were in a market that's kind of, grocery delivering or like food delivering. I feel like it's kind of very occupied by the Uber of the world. And I wonder, how do you kind of find out about the company? Maybe you guys like invest in Fancy, and Fancy eventually become a part of Gopuff. I don't know if you also separately invest in Gopuff. Like, how do
Yeah.
you can you share a little bit more about like how you kind of fund?
Sure. Yeah, no, we led one of the earliest rounds in Gopuff back in 2016. So
Mhm,
long before Fancy,
mhm,
when Gopuff was just in about 6 markets nationwide, we led a large funding round, and that's a company that I did find in Philadelphia, and they weren't well known at the time. They were very early, and actually, I think they've sort of just become popular in the last couple of years, but at the time nobody knew about them. Uber Eats wasn't really big. DoorDash wasn't really that big. Um, and so this was truly a novel business model. And talk about a 10x better product. I mean, this was, it's a magical experience. You tap a button, and 25 minutes later, you have a product delivered on your doorstep, right to your door. I mean, that is, in my opinion, the definition of magic. And so it was a 10x better experience. And Um, not to mention that the growth was exceptional, the unit economics were amazing, right? So there were a lot of exciting things with that investment, and so it was. I think it's easy to kind of look back and say, "Oh, it must have been super crowded, right? You're all these
mhm.
competitors," but actually at the time, it wasn't. It was a very nascent market. They were the first to the market. They had figured out the business model in a very elegant way, and we invested, and they grew extremely rapidly. And then, you know, in the pandemic, they decided that they wanted to expand internationally. And so we invested in Fancy, which was sort of a GoPuff copycat in the UK. And at the time, that Fancy was growing really quickly, and GoPuff said, "Hey, this could be a really good way for us to get into the UK and pursue our international expansion plans." And so they ended up talking to Fancy, and it was a really great match culturally, and so they decided that that would be their first ever international acquisition, which gave them a launch pad into the rest of Europe.
Totally. I guess, like, when you are evaluating the Gopuff business, like, since, like, later on there is, like, the Uber Eats, DoorDash of the world's happening, um, at that point, like, did you suggest them to change business strategy, or do you feel like, I guess, like, how do you evaluate, like, if they're better than the competitor?
Well, Well, I mean, without maybe getting too deep into the GoPuff business model, so they were the first to the market. It's an
Mhm,
extremely capital intensive business model, right? Where they actually have to go um, acquire these micro warehouses in every market that they operate, right? And they have to
mhm,
stock those micro warehouses with physical inventory. So we're talking about a business that is both atoms and bits, right?
mhm,
And it's very hard and expensive to replicate. DoorDash has tried, and there are a number of reasons why maybe it's not working as well. um, GoPuff has to go into each of these markets and acquire liquor licenses,
mhm,
right? Because they sell wine, beer, spirits, and
mhm,
liquor licenses are in many markets hard to acquire and expensive, right?
mhm,
There's a finite number of them, and so they have to go figure out who has them and buy them. GoPuff ended up buying a very large liquor retailer called Bevmo, which has hundreds of stores across the west coast of
mhm.
the United States, right? Which gave them a massive distribution footprint. So there are real moats that build over time in this business, and um, because they were the first to market, they had a big advantage, in terms of the time, and sort of they made a lot of mistakes, and they learned from those mistakes, right? And those are the same mistakes that anyone else coming into the category would have to learn now, right? And in fact, you may have seen, you know, numerous competitors tried to compete. They raised a lot of money over the past few years to try to compete with GoPuff, and the vast majority of those no longer exist. And so there are advantages to being first and to building those deep moats that GoPuff has really adeptly built over time. Um, so that's sort of what I would say in terms of the advantages of that. That said, I mean, it's a very competitive market. Quick commerce is maturing, It's not easy. It's capital intensive. So,
Mhm.
but Gopuff is sort of the creator of that quick commerce category.
Totally. I think, like, whenever you're talking about, like, a physical like, when you mentioned about buying mini warehouses, anything intensive or, like, including physical stores are kind of harder to receive, like, venture money. What were, like, the I guess, like, the mental framework that you were kind of, like, using to evaluate if they should build a very capital intensive business to get the moat? And how do you evaluate if the company can keep receiving capital to a degree to, like, pull it off on this, like, capital intensive strategy?
Sure. So there are two things. The first is, and sort of what we've been talking about in the past 45 minutes, but first assessing, is there long-term value to the end customer? And with GoPuff,
Mhm,
it's glaringly clear
mhm,
that a portion of customers sticks around forever. They want this service. There's a real product market fit, right? And so from a demand side, customer side,
mhm.
we know that there's a there, right? That the
Mhm,
customer will continue spending money with GoPuff over time indefinitely. Then you have to sort of look at, does the business model
mhm,
make sense? Does it work? Is it capital efficient? And we know from investing very early in GoPuff when they were, 6 markets and in those early years that in fact they can be profitable in markets, right? They were when we invested, right? We know that the
mhm,
unit economics fundamentally work. And so we know what the equation is to open up new warehouses, right? And so we got very comfortable with that and we're in fact very excited by that when we invested. And that's what other investors saw as well. And so, at this point, it's figuring out how to scale, right? But we know that the demand is there. We know that customers love this service. They stick around. We know that the business model can be profitable. The unit economics work. And so, that's what gives us comfort in that investment.
I wonder, so, like, when it comes to, like, since, like, AI is everywhere, like, I really like that you guys have both, like, companies like Honeycomb, which is, like, riding the AI wave, and there is companies like GoPuff, which is more towards, like, the traditional, like, consumer side of things, so there's, like, a balance to it as, like, no matter what trends people decided to pick on, um, it can succeed, and, like, I wonder when it comes to portfolio construction, um, how do you decide to, like, spend time on, the more consumer-facing companies versus, like, the SaaS tools?
So, you know, we're we're focused fundamentally on driving returns for our investors, right?
Mhm, mhm,
We will invest in the best opportunities, within our opportunity set that we can
mhm.
find. And whether those are consumer oriented or software oriented, we will invest in the best opportunities in our opportunity set. And so we have had a long history of investing in amazing consumer companies. Sonos is a hardware company, right? That builds
Mhm,
consumer hardware, obviously. Farfetch, The Real Real, Bumble, Acorns, GoPuff, Fetch Rewards. I mean, there's innumerable consumer companies that we're very proud of that have driven real returns for our investors. It's part of our DNA, and so we'll continue doing that. That said, equally have had success in software segment, go to my PC going way back,
mhm,
Appfolio, Nginx, Honeycomb, you know, Pismo, which was acquired uh, by Visa for $1 billion recently. I mean, so we've done both, and we'll continue doing both. I think fundamentally, we're looking for companies that can be real drivers of our fund and our performance and have a meaningful impact on the world and drive outsized returns.
I wonder, so like since like a lot of the listeners may be investors in like a even earlier stage or like in the early stage of building their career in investing, what's your advice on like selecting a particular sector to go into? Since like I know that like you guys have a way more diverse portfolio and a more like robust strategy from like the product market fit level, but a lot of the people may not having like a $4 billion under management fund as an under management fund. So like most people maybe having like a smaller fund. Where do you see as like the most opportunities are coming from for like the smaller check size investors?
Well, but the reality is, opportunities will come from all these sectors, right? Whether it's fintech or consumer tech or B2B SaaS or infrastructure software. I mean, there will be and there will continue to be opportunities. And if anyone tells you authoritatively which opportunities are going to be coming, that they have no idea, right? I mean, none of us know, particularly with this massive technology shift of AI. So I think the key really is, and this is a little bit probably overused, but you have to do what brings you joy, or else you're not going to be successful at it, right? You have to do what you think is fun. If you think that infrastructure software is the driest, most boring, sector in technology, you probably shouldn't be spending your energy there, right? On the other hand, if you think, financial technology, fintech is, extremely exciting, and you really you love talking to those founders and thinking about fintech, that's probably where you should be spending your time. And I do think that there are benefits to focus, right? And so the minute you figure that out about, and this is directed to any junior investors, but the minute you figure out kind of where you have fun, right? Where do you have fun? Where do you really dive in? Where do you sink your teeth in? What gives you sort of meaning? And that plus early signs of success, that's when I would double down, right? That's when I would double down.
I wonder, like, what's your thought on like AI in consumer tech? Because I feel like living in Silicon Valley, there's so many companies that are just coming from like the infrastructure side, dev tool side, but um, I don't think I hear a lot of people talking about AI in the consumer tech economy. Like, have you seen any company that are really interesting in this area? Like, and yeah, why don't we start there?
Yeah, no, I mean, I actually think, I mean, look, again, if anybody tells you they can sort of predict what happens with AI, I think they're full of it. But I think consumer tech is one of the most exciting areas for AI. I mean, think about the biggest, the most well-known AI product that touches more consumer lives than any other product on the planet is ChatGPT. That is a consumer product, right? And it's developed by OpenAI, of course, right? And you have, um, every day we see the most exciting applications of AI in consumer, and I think it's going to be a rebirth for, I don't think consumer ever went anywhere, but I think that this will be a huge catalyst for consumer technology founders. And we're going to have the next wave of Metas, of Snaps, of Googles, right? And that's going to be driven by AI. Those are all going to be consumer companies. And so I think it's an incredibly, probably the most exciting time to be investing in consumer technology since I've been in this business.
Totally. Besides, like, so since like a lot of people are focusing on like the foundational model versus like, I guess like the application layer, assuming you guys are looking more closely to the application layer, how do you evaluate if a person or if a company have like the longevity of or like not longevity, but like I guess like how could they keep innovating And like, I guess like, because when people talk about like the application layer of AI is always like, it's people call it like GPT wrappers. So
Hmm.
maybe they have a better UI or UX or like consumer facing side of things, but it's easier to be copied by other businesses. How do you kind of evaluate if a certain company will be better than others in that category?
Yeah, it's really tough. The AI wrapper argument I always found kind of interesting because and somebody else, I won't take credit for this, but somebody else suggested that all of software is a wrapper on a database,
Mhm.
right? Software is a wrapper on a database, and so it goes back to what we were discussing, which is we look at the usage, we look at the activity, we look at whether the users of the product are sticking around in the long term, whether their activity is suggestive that they will be long term users of that product. And I think in AI in particular, it's a little misleading at this phase in the cycle because people are excited about AI products. They're trying lots of things, they're experimenting. And so you can be a little misled by the data. There are a number of companies that raised a lot of money based on some early traction and already are no longer around um, or not doing very well. And so we are very sensitive to that. We're learning from that. We're not getting trapped by that. But fundamentally, it's going back to that core concept that we've talked a lot about, which is there long-term usage activity retention in that product?
Totally. Okay, so we're at the last part of the interview. I want to give you a little mini fire round. So first question, what's your favorite book?
0 to 1.
What's your content diet look like?
Oh, I'm a voracious consumer of content. I read a lot and everything from magazines to leading newspapers, international newspapers, blog posts. I constantly consume content.
What's your favorite magazine? Do you read the physical magazine or like
I
just
read
like
the New
online?
Yorker. Yeah, yeah, I read the New Yorker. I mean, I read everything. I invest in consumer too, so I read all of the. I'm looking for trends early. I'm looking for what people are excited about. So we look at all of the popular culture magazines, the fashion magazines, all of them.
I love your job. You're reading the fashion magazines.
We do
So
as a team. Yeah, we have to. We have to stay on top of the trend spotting really early and knowing what's in the zeitgeist is really important.
what would be the things that you're looking for in these content consumption? It's like, do you have like a routine? Like, every day, 6 a.m., you start with the New Yorker and then move it towards Vogue, and then there's like five other things that you on your reading list, or is this more of like, oh, in my free time, I'm just opening up something?
No, it's not sort of as structured as that. It's mostly opportunistic when I have time. I'm reading
Mhm.
online generally. But there are, the usual suspects that I like to read. I probably like to read the sections of the newspapers that, most, people don't read. I like the popular culture. I like the art section. I like I like, that's where you actually find ideas that others may not be the most drawn to, right? And particularly in consumer oriented investing, it's important.
For sure. I completely agree on like study the culture. Because I feel like all the technology or like human consumption is kind of all coming from the culture side of things. Okay, so who made the biggest impact in your career?
That's a great question. I have a I have a mentor who was a former partner at Sequoia Capital. His name's Bob Cohn. He was the founder of a large telecommunications company that went public, and he's been very, very helpful to me over the years.
Um, who would you invite to your dinner party?
Pablo Picasso.
Oh wow. That's so interesting. Where can we find you outside of work?
I have two daughters, so I'm usually chasing them around when I'm not working.
Amazing. What's your Gopuff order?
Sorry,
What's
what's
in
my
your
GoPuff
Gopuff?
order?
Yeah.
Nerds Rope, Dr. Pepper, uh, and these days maybe a Starbucks latte because now they just launched. They're the on-demand partner of Starbucks, so you can get any of your favorite Starbucks orders on GoPuff in 30 minutes or less.
Amazing. Wow. Well, Jett, thank you so much for coming on the show today. It was a fun conversation.
Grace, thanks for having me. This was fun.
Let me quickly